So this is the pension series in which I will cover around 8 major topics, including pension basics, employee contribution, self-employed contribution, contribution through your company, then benefits of pension, buying a commercial property through your pension, then critical pension mistake, and then finally withdrawal rules. So under each category, I have analyzed or I have considered a couple of points. Like under the pension basics, there are types of pension, what is auto enrollment, what is difference between state pension and private pension allowance, how much should I save into pension, types of tax savings. And under employee contribution, I have included the major things are salary sacrifice and private pension. And under self-employed, I consider benefits of pension, contribution as a self-employed, then tax implication of pension, how much you should save, and so on. For each video, I will reveal at the start of like what that video will include, and then at the end what we have covered, so this way you can understand what we have covered so far. In this video, I am going to discuss 3 things. Number 1 is benefits of pension. Number 2 is tax implication of pension operating as a self-employed. And obviously, number 3, I will answer your question, how much should you save into your pension pot operating as a self-employed. If you are a self-employed, then contributing into your pension pot will be more difficult for you than for employees and people who have a limited company. By the way, as promised in my previous videos, including tax planning for a sole traders or self-employed, tax planning for a limited company, and tax deductible expenses, finally I have started a pension series in which I will cover 14 topics, including tax implications of pensions for limited companies, for self-employed, and for employees. I will also cover some pension basic, and then I will explain how you can buy a commercial property through your pension fund. I will then conclude a pension series by publishing a video on how efficiently or tax efficiently you can withdraw a pension from your pension pot. Now coming back to the main video, in self-employed, there is no one who can choose a pension for you. There is no employer contribution for you into your pension pot, and probably your income will fluctuate. But there are many advantages for having a pension as an self-employed. Some self-employed people say that their business is their pension. They will sell a business when they want to retire. But for many, they are the business. When they retire, business have no value. What if your business is your pension and it goes bust? Then not only you have lost your work, but also you don't have a pension. There are 4.8 million self-employed people operating around the UK, accounting for around 15% of UK workforce. Yet just 31% of these self-employed people are contributing into the pension pot. As a self-employed, one of the big challenge you will face, you don't have an employer contribution putting into your pension pot. Now let's have a look on tax implication of pension contribution operating as a self-employed. Contributing into your personal pension pot entitles you a tax relief from government up till the rate of income tax you pay. So if you are a basic tax rate payer, then government will top up your pension pot by the rate of 25%, which means contribution of 75 will be considered as £100 into your pension pot. The government contribution is automatically provided at the basic rate. Here is the demonstration. Now on your screen you can see a self-employed profit. Let's say you are basic tax rate payer and your profit is 45,000 and you contributed £10,000 into your pension pot this year. Now if you see in the middle, your basic band rate has been increased by 10,000 to 47,700. Since you are basic taxpayer, so you automatically get 20% tax relief on your contribution. Now let's have a look at if you are higher taxpayer. Let's say your profits are 75,000 this year and you have contributed 10,000 into your pension pot. Now in the middle you can see your basic band rate has been increased to 47,700 from 37,700, and on this amount 20% tax rate will apply, which means that you will get 20% additional benefit if you are a higher taxpayer, which in this case, you get through extension in your basic band rate. The key thing to be in mind that you cannot contribute into your pension pot more than your available profits. Let's say if your profits are 30,000, then you can only contribute 22,500, which then government will top up by 25%, and then it will be worth 30,000. However, you cannot contribute 30,000 as a whole amount into your pension pot, because this will then convert your profit into your loss, which you cannot do it. And if your profits are 70,000, so you can only contribute up to the maximum of 60,000, which is a pension allowance or annual pension allowance, which I already cover more in detail in my pension basic video, so you can must watch. The link is up here. Now the final question young entrepreneur asks is, how much should I save into my pension pot? A good rule of thumb is to save into your pension pot as a percentage of your earnings, half of your age when you started a business. So if you started a business at the age of 24, then you must contribute into your pension pot 12% per annum. A quick recap: in this video we have covered three major things for self-employed. Number one is benefits, number two is tax implications for self-employed people, and number three is answering your question, how much you should contribute into your pension pot operating as a self-employed. Guys, please leave a comment, any question you might have, anything you want to share, any thought, any future video you want to watch, please do let me know. As always, hands ahead, salute, until the next video.